All right, so let's begin our very special segment, Meet Your Fund Manager, where today the category in focus is aggressive hybrid funds. Hybrid is a very large category where, as per your risk appetite and the kind of exposure you want to have in equity and debt, you can align your portfolio by having the right kind of hybrid category fund. But then today the fund in focus is of a very aggressive hybrid category, and we'll be talking about ICICI Equity and Debt Fund, for which I have Mittul Kalawadia, Senior Fund Manager, ICICI Prudential AMC. Mittul, good evening and welcome to the show. And while we will get into the nitty-gritties of these fund, but then before that, I want to really understand your take on equity markets, the way it's shaping up today. We had the first day of the week, and it wasn't a very optimistic start. We have entire day where we have crucial data coming in from the international markets. What is your view on the markets ahead?
So a couple of points to look forward to. There are a few positive things for the economy to look forward to. So the monsoons improving is actually a very good thing if one were to look at. It could have affected the Rabi crop more than the Kharif ones, but now at least with this improved monsoon, things should be fine in the second half. Coming to the areas of concerns, if one were to talk about, then it could be the rising crude price, so it would have some pressure on the currency due to rising trade deficit. And more importantly, if you were to think about that, if it remains here, then it might still not be a big negative impact. But whether it will stay here or it will go up, crude is a commodity which is very difficult to predict where it will really end up, because there is not just a fundamental demand supply side, but there is also what you can say a geopolitical angle which plays a significant role there. So we would prefer to take it as an input rather than trying to predict it and then base everything out of it. As of now, it's not a big negative, it's a marginal negative, but that's one area of concern to keep it in mind. The other areas are the rates. How will the global rates behave and what are the global risks? From the global risk side, maybe the US commercial real estate is one area, another where there can be some risk, but there has been a lot spoken about or talked about. So maybe there has been a good amount of time available for things to get corrected there. Coming to the most important reason which I feel one should actually focus about and very less gets talked today about it is the valuation per se. If you look at the overall market valuations and different pockets of markets of valuations, then there is a lot more discomfort because the valuations are getting pretty expensive on many of the pockets. And if the rally continues in the market the way it has been very sharp today, if it continues for longer, then it would get into a zone which will be more frothy. Already there are certain pockets of market which are getting frothy, but its overall markets still on the large cap sides are still okay. But when you
Right.
look at some of the mid caps, small caps, and some of the micro
Mm-hmm.
caps,
Mm-hmm.
those are where there is a slightly area of concern, and one should be cognizant of this. See, once
Right.
whenever
Right. The coming quarter earnings, you think that's going to set the mood going ahead in the festive season? I want to elaborate more on that point where you highlighted that mid cap and small cap is slightly a sticky zone right now, and large cap being more comfortable as far as valuations are concerned. But then before that, I want to understand your view on corporate earnings and the way it is going to set the tone of the markets in for coming months, especially considering the festive season.
Sure. The consumer festive season demand side seems to be okay. So most of the areas of consumption related should do well. Maybe Q2 in terms of numbers may not be so much, but Q3 is the one where the actual festive season demand would really play a big role. And that seems to be at least shaping up in a good way. We are getting early signs from some of these consumption companies which suggest that things have already started to improve at the margin. Now, whether that momentum continues or not, but whether the results of this quarter will be great or not, actually the commentary, I think, from the managements would be more optimistic, and that should allow some of these stocks to deliver. Coming to the other set of stocks in the market, So hotels, again, part of consumption, that should be okay. But when you come to industrials, cap goods, autos, or IT, metals and all, broadly, we have not come across any areas where there will be a big concerns on the earnings going forward. Banking is one where people are worried whether we are at the top of the cycle and whether the margins will get squeezed going forward. There might be something, but already the expectations are also set there. So it's not the earnings which would be a major worry in the near term, at least from this quarter point of
Okay. We also to talk about the fund in specific over here, equity and debt fund. But then before that, just a small questions on large cap valuations and how uncomfortable do you think is the mid cap, small cap space for you now as a fund manager?
view. In terms of valuations in the mid and small cap side, they are expensive. But is it that the whole basket per se, is it into a really frothy zone? The answer may not be yes. We have some internal models which suggest the kind of some kind of a sentiment indicator in terms of market caps. So the market caps of aggregate between large and mid cap, mid and small cap, when you see, they are closer to all-time highs, and that should talk about a lot about the sentiment of the investors in the market. People think that also, if you combine it with the flows that you get in the mid and small caps, that both set the tone, saying that this is one area which everybody thinks is going to make a mega money in the long term, and that's why maybe people are ready to let go of the short-term returns, because when the valuations are expensive, if you have you are trying to borrow some part of the future returns today. So that's the short take. I think some of the sectors or some of the stocks are getting into a zone where some of these cyclical names are trading at some of the valuations similar to a stable or a secular companies, and that's the area of discomfort, because the earnings longevity may not be so long, and then those valuations may not sustain.
Mittul, now let's talk about the equity and debt fund that ICICI Pru has. And very basic question, I want to start this interaction, and we'll go in depth with about the fund strategy and exposure also. But then talking about the specific category in focus, what kind of investors do you think should be aligning towards these fund, or should have this kind of an exposure or fund in their portfolio as far as their long-term goals are concerned?
Sure. Actually, it's suitable for investors who have a slightly longer horizon of time. Somebody who has, let's say, a 10 or 20 years of horizon, somebody who is in their mid 30s or early 40s and has another 20-25 years of their work life for them to generate their savings. This fund suits them because they have a longevity to stay invested. The way we run our fund is based on three sources of creation of alpha. So we don't try to be static fund on the large cap, mid cap allocation. We try to be more dynamic. At the same time, we also try to be dynamic on our cash levels in the fund. And that should allow the investor to do a auto check on their allocations, on their allocations between both the categories between debt and equity and large cap, mid cap, small cap. So we do it for them within the fund rather than they trying to do it themselves. I think that's the whole purpose of the hybrid as a category.
Right.
And
So the
that's why we
question and concern with this kind of a strategy that you as a fund manager adopts is basically how is the exposure aligned in equity and in debt, and talking about the exposure, how risky or how less risky the fund becomes for an investor.
Sure. See, in terms of allocations between the cash, and there is some kind of a cash model that we have along with our other hybrid funds where we use something similar there. Based on that, we keep gradually changing our allocations between debt and equity. At the same time, in terms of risk, one were to talk about, markets inherently are volatile. So there are always, and it's also driven by sentiments. So markets tend to go into extremes on both the side. and it is very difficult to always predict when it will happen. So frankly, we might be uncomfortable with the valuations today on mid and small cap, but that doesn't mean that the rally has just ended and tomorrow is the fall. That's very difficult to predict. All you can do is try to plan for it. All you can do is try to get yourself ready for it. So it's better to be prepared when the corrections comes. They are very sharp and then they are very brutal. It's better to be prepared, and the best way to prepare yourself is by being systematic about it rather than trying to be more emotional about it and trying to catch the momentum there. It's very difficult to catch the momentum. So that's what we try to do. We try to be more systematic. Slowly in the past, if you look at our fund between 2018 to 2020, systematically we increased our mid and small cap allocations in the fund. That benefited over the rally, for the rally from 20 to 21 and some part of 22. And then we had again reduced some part of our mid and small cap allocations out there, which helped us to protect a lot of alpha between 2021 and 22, when suddenly the crude spiked and due to Russia war and the inflation became a concern and rates started to rise.
Right.
It helped us during that time.
Okay. Mittul, if you could just reiterate on this point as to how much is the equity and debt allocation right now in the fund?
Sure. So it would be somewhere around 67, 68%.
Okay.
That's what number would look like.
Okay. Also, going in specific with your equity exposure, what's the market cap exposure in terms of percentage?
A large part, so somewhere around mid and small cap should be less than 10%. So something around 7-8% is where we are in mid and small cap put together. Rest all is the large and the super large.
So, considering the kind of run-up that one saw in mid-cap and small-cap, you think that the fund missed that rally and the kind of profits an investor must have got because you have a very restricted exposure in mid-cap and small-cap?
See, these are always tricky. So like we had our set of mid and small caps which did participate. We had some of our thematic calls or the counter cyclical calls also work for us. So that has actually made up for some part of the mid and small cap rally which has happened in the near term. But these are things. What we have seen is that it is better to stick to the model that we had. In the model helps you over the longer period of time. In the shorter term, it might look like that you are missing the point, but frankly, it is more important to be systematic rather than trying to get carried away by the momentum. And it's difficult to really change course when things really change in the markets. You could have seen it in the last. There was in the last 2 weeks. There was one day with a very
Right.
sharp, and it would have been
Right,
very
which is why it's always
difficult.
advisable to have a longer term strategy as far as having an equity exposure is concerned, and even if it's an aggressive hybrid category. But having said that, you have large and super large caps in your portfolio. Across market cap, sector wise, what's the allocation? Where are you heavy and where are you right now less than average, which you think might be extended in coming months?
So our top sectoral ideas which we like is power. Then we have auto, telecom, oil and gas. These are the top large orbit ideas where we are more positive. And our approach while investing or looking at sectors is more like a counter-cyclical and being contrarian. Along with that, we also try to do a bit of a bottom-up stock picking. So all these three combination allows us to create this portfolio. We have been positive on power for the last 3-4 years now. The reason being that the sector has gone through a long cycle of downturn, and we are headed for a good 3 to 5 years of an upcycle. This sector actually has a cycle which is longer in nature than the general other sectors. Apart from that, we feel that the telecom as a sector is a good consolidated sector. It's also one of the cheap way of playing for consumption stocks. Then coming to auto, auto is more bottom up there. you have to get the model cycle for the companies right. You have to understand what companies are going to do and how their market shares are going to change over the medium term, over the near term, and then accordingly look at stock ideas. And that's what has helped us. In fact, auto is such a wide sector that there are wide varieties of style that you can apply there. There are some turnaround stocks where there is a balance sheet repairing going on. You can be invested into those. And what we have seen in the past on metals name, when there is a sharp reduction in debt, there is a good amount of equity upside which happens. Something similar names are
Right.
possible
Right.
auto on the investment side.
Right.
Similarly,
Right.
as are also there.
Right. So, given the current scenario and given the current interest rate scenario, how are you placed in debt? How long or how short are you placed in debt? How is that part of the fund playing out for you?
So we don't have a very high durations currently. So duration side is lower, uh, given where we are in the cycle on the rate side.
All right. Now, considering this kind of a fund also has more equity and less debt exposure, in order to place this fund in your portfolio, what should be your other references in the portfolio? In the sense, how can you align it with your entire equity exposure and with your entire debt exposure? You know, not going over diversified in either of these categories, because you have an aggressive hybrid fund which is slightly large cap biased. Okay, would you recommend an investor that if at all they have a fund like this in a portfolio, they might want to focus on other exposure, other funds that give you better exposure in mid cap and small cap, and maybe an entirely debt oriented fund? Do you think that's how a portfolio can be built if one has ICICI Pru equity and debt fund?
Actually, that may not serve the purpose. The reason for having slightly lower mid and small cap today is based on the expensive valuations. So if one tries to buy ICICI Prudential equity and debt fund and then goes and buys mid and small cap separately, then actually it might look like a prudent thing to do from a overall allocation point of view, but given where the valuations are, may not be the right strategy to do. The reason I would say, in fact, a good allocation to our fund can be made so that then you don't need to actually go and do the separate allocation to mid and small cap in that sense. And then when there are times like between the 2018 to 20, market invariably goes through such cycles of poor returns in the mid and small cap. We did had a higher allocation of mid and small cap into our portfolio then. So that's how we try to be systematic. It's the way to put position is that instead of one trying to do the allocation between various categories on their own, one can actually allocate a large proportion of the portfolio to this fund and be invested for a longer horizon. And that's when you actually tend to benefit from the market cycles over a period of time.
Got it. All right, Mitul, thank you so much for being on the show today and helping our viewers with the market movement ahead and also the kind of strategy you are opting for the fund. Thank you so much.